Well, good morning. I am Jagendra Rana. The topic for our discussion today is trade credit insurance in India. Trade credit insurance in India. The insurance regulator issued revised guidelines for trade credit insurance, which has come into effect from 1st November 2021. The aim is to promote the sustainable and healthy development of trade credit insurance business and improve economic stability by leveling trade losses because of credit risk. These guidelines apply to sell or to all insurance companies transacting general insurance business registered under the Insurance Act 1938. Our ECGC Limited, that is Import Credit Guarantee Corporation of India Limited, is exempted from the application of these guidelines. The trade credit insurance protects businesses against the risk of non-payment for goods and services. It usually covers a portfolio of buyers and indemnifies an agreed percentage of an invoice or invoices that remain unpaid as a result of protracted default or insolvency. It contributes to the economic growth of a country by facilitating trade and helps improve economic stability by addressing trade losses because of payment risks. So the scope of cover under the trade credit insurance policy will be the credit risk that has a direct link with an underlying trade transaction, the delivery of goods or services according to the IRDAI circular. If no such direct link exists, the outstanding amount is not insurable under a trade credit insurance policy. So the cover may include commercial risks such as insolvency or protracted default of the buyers of goods and services. The trade credit policy will also cover rejection by the buyer after the delivery subject to conditions of a policy contract. The cover could also include non-receipt of payment because of the collecting bank's failure. For the revised guidelines on trade credit insurance, that is IRDAI Trade Credit Insurance Guidelines 2021, is a very positive step from the regulator. This will help suppliers and licensed banks and other financial institutions get insurance protection, which will help them manage country political risk, open up access to new markets, and manage non-payment risk associated with trade financing portfolio. The political risk cover is available only in the case of buyers outside India and in respect of those countries agreed upon. The political risk include operation of a law or an order restricting the transfer of payment from the buyer's country to India. They also include war between the buyer's country and India and civil war, revolution, revolution, insurrection, or other disturbances in the buyer's country. So as far as the Trade credit insurance market worldwide is expected to reach a projected revenue of US $22,125.5 million by 2023. There is a global trade credit insurance market size and outlook. So a compound annual growth rate of 11.1% is expected of the worldwide trade credit insurance market from 2024 to 2030. So this market is going to expand because the Union Budget 2025 is expected to bring transformative reforms to India's insurance sector, accelerating its growth and enhancing accessibility as part of the country's ambitious Insurance for All by 2047 vision. So, the businesses and companies of all sizes, small, medium, or large, need some kind of safety net to manage the financial risk arising due to customer defaults. This can be done by taking a credit insurance that provides safety, security, and peace of mind to grow and expand the business. So, in fact, what is the credit insurance? That is important to understand. So, a credit insurance is a type of business insurance designed to protect businesses from commercial and political risk that may impact the finances of the business. Such risk can be beyond the control of businesses or individuals. However, safeguarding against risk like loss or damage to the business is important to expand the business. Many national and private insurance companies in India provide credit insurance. This helps business owners overcome the loss due to customer defaults and in turn improve quality, increase business profits, and reduce risk of unpredictable customer insolvency. It also protects exporters against any loss incurred during exports of goods and services. So this different type of credit insurance policies are like credit life insurance that helps pay off the debts in case of the sudden death of the insured person. Then credit disability insurance. If the insured faces permanent disability due to any reason, the insurer will pay off existing debts. And credit involuntary unemployment insurance. It aids in paying some or all of existing debts if the insured is involuntarily unemployed. And then credit property insurance. It protects the insured's collateral property subject to the theft, loss, or damage. And trade credit insurance. It provides indemnity for bad losses in case of debt receivable due to the failure of customer payments. So what all credit insurance covers? Credit insurance covers two types of risk, commercial and political risk. Commercial risk includes insolvency of the buyer, non-payment by the buyer, and political risk include general moratorium on payment by the government of buyer's country, cancellation of import license, political events, economic difficulties, legislative or administrative measures preventing payment, military or civil war, revolution, riot or insurrection, non-payment by government buyer, government decision preventing performance. Question is how credit insurance functions. So let us understand how credit insurance functions so that when needed you can reap timely benefits. The biggest setback in the working of any business, be it small, medium, or large, is financial loss that can happen due to various reasons. There might be time when you have sold a product or a service to a client or a group of clients and unfortunately and payments get stuck. So if this amount turns out to be huge, it can even lead to shutting down of the business. The credit insurance helps in managing such solution by providing the amount that was not paid by the client. This payment is done in a certain percentage and not 100% of it, as must be pre-specified in the policy document. Any company that has receivables on its balance sheet is prone to loss from the inability or failure of a customer to pay them. Such companies can get enrolled for credit insurance policy. As far as credit insurance claim process is concerned, many national and private insurance companies in India provide credit insurance policies. However, the internal system and process may vary for different companies. Let's go through some of the general guidelines related to the claims process or settlement in India. Immediately inform the insurance company about the business loss or damage covered under the policy document. This can be done through different channels like calling on the toll-free number, sending email, or contacting the nearest branch office of the insurance company. Inform the policy issuing office about the loss or damage in the claim form and submit the processing or settlement. Any police report, if needed as per the case, must be submitted to the insurance company. The process is followed by the insurance company checking all relevant documents like account sales sheet, involved invoices, balance sheet, or any other document requested by the insurance executive. If required, an arbitrator is appointed by the insurance company to calculate the value of loss or damage and suggest the sum assured and other benefits payable to the policyholder based on the individual credit insurance policy documents. So once all legal and internal processes are completed, a final report is submitted to the internal panel for the claim amount to be given to a policyholder. Policyholder would have to submit his or her ID proofs, policy documents, etc., and the amount is transferred to the policyholder's bank account. But this policy does not cover some risk, like not all situations are covered by credit insurance, also called exclusions. Any problems to the business due to following reasons are not covered, like any nuclear risk or contamination due to radioactive substance, customer disputes with the buyer that may result in withholding of partial or full payment by the buyer, an interest amount that gets accrued after the original due payment date, amount owed by any government entity which cannot be declared insolvent, currency fluctuations, reserves factoring policies, pre-shipment risk. So there are advantages of taking this policy because it helps the businesses by protecting their accounts receivables or businesses sales that will be covered into cash soon, thereby protecting the most important assets. This type of credit insurance helps the businesses by providing an opportunity to the manufacturers and distributors whereby they can increase their sales to their existing customers and improve the cash pipeline with almost no risk on themselves. So at times political problems might create an issue in exchange of currency with countries we are doing business, so risk or losses arising due to such a situation are covered by credit insurance policy. Credit insurance policy helps business by optimizing bank financing options by providing insurance cover to the trade receivables. This policy helps by ensuring that cash flow is maintained, profitability is increased, and budgets are protected. It also helps in improving credit decisions through informed decision making by the policyholder. Thank you very much.